FuboTV stock is down over 95% off its long-time highs. But is that enough to warrant a purchase of FuboTV stock? Is the valuation discounted enough to buy this stock? I'll answer that question in this video. Of course, I've had FuboTV stock rated as a sell for over 3 years now. So if you followed that recommendation, you would have avoided this disaster, being down over 95% off the high. But in this video, I'm going to review the company again for 2025 to answer if finally the company has worked itself out of that bottom category and into at least a higher category. I'll let you know by the end of this video.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the things that FuboTV has going for it is that the tailwind in the industry is strong. FuboTV offers a sports-centric streaming TV bundle. And streaming alone is growing nicely because it's just so much more convenient than a cable TV connection or a satellite TV connection. And it's often priced lower, and the installation and getting your service up and running is much easier than a traditional cable or satellite TV connection. And so the industry growth is very strong, and FuboTV is benefiting from that in and of itself without even thinking about anything competitively about its service against rivals like Hulu Live TV and YouTube Live TV, which in my opinion are better services than FuboTV and at more attractive prices. But if you're a sports-centric consumer, then FuboTV might be better for you because sports are included in more of the channels of FuboTV. So more of the price that you're paying is going for sports than for other channels that you might not be interested in. So FuboTV has grown nicely, 1.6 billion in trailing 12-month revenue, and that's up from around 200 million in 2020. Revenue growth has been solid, although it has been slowing down ever since FuboTV started increasing prices. The trouble for FuboTV has been the losses on the bottom line, but that's improving. The operating margin at negative 14.5% is up from negative 50% in January of 2022. FuboTV has made a number of adjustments and cost-cutting moves, including, if you remember, back in 2020 and 2021, FuboTV was talking about launching its own sports gambling on top of the sports TV service. It has since removed those ambitions to save costs, to save money. And so that's one thing that it spent tens of millions of dollars on that it turned out having to stop because it needed to improve losses on the bottom line. It was losing so much money. It was already indebted. It was diluting shareholders significantly. So it needed to make drastic moves to improve the bottom line, and they worked. Its operating margins have improved. On top of those moves that it made to lower cost, it also raised prices. And so that's something that I had been calling for FuboTV to do. They had been hesitant to raise prices because they didn't want to slow down growth, and they were already competing against some strong rivals in Hulu Live TV and YouTube Live TV. One of the ways they were attracting customers is with a lower price. And so they didn't want to ruin that customer value proposition, but they were forced to because not only were they losing significant sums of money on the bottom line, but the cost of capital soared. In 2020 and 2021, FuboTV was able to borrow money at very low interest rates. So was most companies worldwide because interest rates were so low. But starting in 2022 and 2023, interest rates soared by over 500 basis points and more for companies like FuboTV that are riskier. And so they had to take drastic measures to reduce the losses on the bottom line. And so far, they are working. And so cash flow from operations is also improving on a trailing 12-month basis, although it is negative at negative $101 million. The analysts on Wall Street that are following FuboTV stock, they expect the company to continue improving their cash flow from operations over the next couple of years. Return on invested capital is also improving for FuboTV, but it's still significantly negative at negative 31.6%. This is where I don't have very much confidence in FuboTV long term. The content, the sports that FuboTV gets on its platform, it has to pay for to those that own the rights. Companies like Disney that own the rights to ESPN and all the sports content that's on ESPN. FuboTV has to continuously pay. And the big difference between FuboTV paying for content and other studios paying for content is that FuboTV's content, the sports content, is not long-lasting content, right? Tonight, the Los Angeles Lakers are playing the Portland Trailblazers, and the people that want to watch that game are going to want to watch that game tonight, maybe tomorrow morning, right? And then that's it. There is no more demand. There's very, very little demand for anyone to watch that game outside of these next day or two, right? Compared to, let's say, a company that pays for a movie to be created or a series of episodes to be created. Those can be watched now, 5 years from now, 10 years from now, 20 years from now. I find myself watching movies from 10, 20, 30 years ago all the time, right? But that's the difficulty for Fubo, is that the content that it pays for and it's very perishable, and then it goes away. And so they're not delivering long-lasting value with the content that they are paying for, and they're already losing money on the bottom line. So they're going to have to continue doing that. The long-term advantage, the scale advantages that you usually get with content companies like Netflix, let's say, you don't get that advantage with Fubo TV. So it's more of a, can they scale this business large enough to where they can generate profitability on each and every month from the content that they're paying for? And I've doubted that, because the content owners, they don't have very much incentive to give Fubo TV favorable treatment. And Fubo TV is not going to have negotiating power against a company like Disney, which has its own streaming TV bundle and its own streaming sports service in ESPN Plus. So if Fubo TV were ever to try and flex its negotiating power against Disney, Disney will just say, fine, if you don't want to pay for our content, goodbye, see you later. We'll just capture your customers, bring them to our service, and we'll generate more profit by cutting you out of the mix. And so that's why I haven't been confident. That's the primary reason why I've been so bearish on Fubo TV stock over these last 3 years. I mentioned that I've had it rated as a sell for several years now. I last updated this recommendation on August 7th, 2024, rating it as a sell. I've had it rated as a sell since 2020, 2021, since I started following this company. Hopefully you haven't been losing money on this stock. Hopefully you followed my research and avoided this stock. But what about now? After all of those declines, Fubo TV is now selling at almost the cheapest valuation it has traded for in its history, at a forward price to sales of 0.224. And if you look at my discounted cash flow valuation model for Fubo TV stock, it suggests the intrinsic value per share is $1.50. The current market price is $1.41, so it's about fairly valued. So all that being considered, is the stock still a sell? I'm going to say no. I'm going to upgrade Fubo TV stock here in this video to a hold. I think the company has done enough to remove itself from my bottom category of absolute disasters to avoid. I think they've done enough progress with the cost cutting and price increases, and they're benefiting from the industry tailwind, lifting all streaming providers. So If I were to answer buy, hold, or sell for Fubo TV stock in 2025, I say it's a hold. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.